Hello everyone, my name is Victor Lai with BCM and welcome to Understanding the Yield Curve. I made this video because the yield curve has been a very popular topic lately, both in the news and within the industry, and we've also answered a lot of questions on the topic at BCM. So I thought making this quick primer would be helpful for some people. We'll start by breaking down the yield curve. What is it and what is it made of? Next, we'll talk about how to interpret the yield curve. What information can we extract from it? And last, we'll look at why it all matters to investors. Okay, so what is the yield curve? A yield curve is a graph that plots yields over maturities for a specific type of interest-bearing instrument. For example, if you walk into a bank and you want to put your money into a CD or a certificate of deposit, one of the first things the bank will ask you is, what time period or maturity do you want? Normally, the longer the maturity, the higher the interest rate or yield you can expect. So if we were to plot those yields and those maturities onto a graph, we'd get a yield curve like the one you see here. The yields are plotted on the vertical axis, and the maturities are plotted on the horizontal axis. Notice that as we extend our maturity from left to right, the yield rises. In other words, as we move from 5 years out to 20 years, the yield goes up. This upward sloping curve is considered normal, and it's what we should expect under normal circumstances. Now, a couple of things to note. First, a yield curve shows us yields for a specific point in time. That can be a little confusing because the graph shows multiple maturities, right? You've got 5, 10, 15, 20 years here, for example. But all those maturities and the corresponding yields are for one specific point in time. So in other words, today we can get a 5-year CD or a 10-year CD or a 30-year CD, and they would all have specific yields. But all of those yields are only for today, because by tomorrow, all those yields could change, and thus so would the yield curve. The second thing to note is that there are many different yield curves. There could be one for CD rates, like we just talked about, but there could be one for mortgage loans, one for corporate bonds and government bonds, and so forth. But typically, when people talk about the yield curve, like there's only one, they're usually referring to the yield curve for Treasury securities. Or in other words, the yields that are available on U.S. government debt issued by the U.S. Treasury in the form of bills, notes, and bonds. And the reason that people look at Treasury yields in particular is because they are used as a benchmark for other yields and rates all around the world. So we know what the yield curve is, we know what it's made of, but what does it all mean? Well, in simple terms, we can think of the yield curve as a reflection of economic growth expectations. And that's because Treasury yields, for the most part, they are determined by market forces. So when the market has positive growth expectations, meaning the market expects growth to increase over time, then what happens is long-term yields, which reflect long-term growth expectations, will be higher than short-term yields, which reflect short-term growth expectations. And that's going to result in this positive upward sloping yield curve, which again reflects rising growth expectations over time. This positive upward slope is considered normal, and it's what the yield curve should look like most of the time. But sometimes the yield curve looks abnormal. Specifically, what happens is short-term yields move higher than long-term yields, and the yield curve kind of flips upside down. This is what we call an inverted yield curve, and that's shown here. You can see that the downward yield curve, the downward sloping curve, that's basically telling us that the market expects economic growth to fall over time. It expects short-term growth to be higher than long-term growth. And so that is indicative of a negative outlook for the economy. Okay, so why does all this matter, and who cares anyway, right? Well, it turns out that an inversion of the yield curve has been historically a pretty reliable indicator of recession. In other words, whenever the yield curve inverts, usually an economic recession follows. This chart plots the spread, or the difference, between the 10-year Treasury yield and the 2-year Treasury yield over time. That's shown by the blue line. Now, when the blue line is high up on the chart, that's telling us that the 10-year yield is a lot higher than the 2-year yield. That would be like in 1993, 2003, or 2010. Okay, during those times, the spread between the 2-year and the 10-year was really wide. And that also meant then that the curve would have been very steep and very much upward sloping. Now, if we look again at 2003, near the peak of the blue line, notice that after the peak, it starts to fall as we move from left to right. That meant as the spread falls, as it narrows, that means that the 2-year yield and the 10-year yield are getting closer together. And it also means then that the slope of the yield curve would have been getting flatter and flatter. And it would continue to flatten until about 2006 and 2007, when you can see the spread actually went negative. It crossed below that zero line that you see, the black horizontal line, that's the zero line. And when it crossed below the zero line, that would mean that the yield curve inverted, right? The 2-year yield went above the 10-year yield. And so you would have had a downward sloping yield. And in hindsight, of course, we know that 06, I mean, that was basically the start of the great financial crisis. And if we look back in time, yield curve inversions have consistently occurred prior to recessions. So on this chart, the recessions are highlighted by the gray bars. You can see 1, 2, 3, 4, 5 recessions on this chart here. And just notice that unmistakable pattern of yield curve inversions followed by recessions. Right, and you can see right now in 2019 how close we are to an inversion. Now, in fact, this curve actually did temporarily invert today, August 14th, and that's the first time that has happened since 2007. And you know, this matters because, like we said before, the yield curve is a pretty good indicator of recessions, and bad things tend to happen during recessions, like the markets fall, businesses go bankrupt, people lose their jobs and homes. A lot of bad things happen. So if we can anticipate recession, if we can better anticipate recession, then we can better prepare ourselves, whether defensively or in order to take advantage of potential opportunities. So the point is, the yield curve is important to watch because it has real-world implications. I said earlier that when people talk about the yield curve as like there's only one, they're typically referring to the Treasury yield curve. But it's worth noting that there's actually more than one version of the Treasury yield curve. We've been looking at the 2-year versus 10-year version, but some people prefer to use the 3-month yield instead of the 2-year yield at the short end of the curve. As an example, the Federal Reserve Bank of New York prefers this measure, and they have a very popular recession probability model based on it. So we can see this version of the yield curve here on this chart. It shows the spread between the 3-month and the 10-year Treasury. And you can see that historically, it's had about the same recession forecasting accuracy. But one thing that is different is that this curve has already inverted earlier this year, and it's been inverted. So there's been a lot of talk, a lot of chatter about this inversion. You can see that on the far right that the spread has dipped below the zero line. Now, since the two curves can obviously offer different interpretations, different information, people may wonder, well, which one is more accurate? The 3-month or the 2-year version? And my opinion is that neither one is perfect as an indicator. They have both produced false positives in the past. And one criticism about the 3-month yield is that it is heavily influenced by the short-term rates set by our central bank, the Federal Reserve. In other words, the Federal Reserve has indirect control over the 3-month yield, and a lot of people would say that the Fed is inappropriately manipulating short-term rates. But the point is, whether that's true or not, the point is that those same people would say the 2-year yield is a more accurate reflection of market-determined short-term rates because the Fed has less control over that yield, over the 2-year yield. Now, all of this is subject to debate, and there are points to both sides. I would say the important takeaway here is the fact that the two curves can generate different signals, can say different things, and so we shouldn't just rely on any one indicator. Right? All indicators can be wrong. So regardless of which one you favor or which one you think is right, really the right way to use the yield curve is in conjunction with other reliable indicators, and then look for trends and confirmations over time across all those indicators. Okay, so that wraps up this video. I know we went over a lot of stuff, so let's just do a quick summary. A yield curve is basically a graph that plots yield over maturity. It's typically used to show term yields for interest-bearing instruments like CDs, bonds, and the most popular yield curve is the yield curve for U.S. Treasuries. Now, we can think of the Treasury yield curve as the market's expectations for growth. When expectations are positive, the yield curve is upward sloping and long-term yields are higher than short-term. When expectations are negative, the yield curve is downward sloping with short-term rates higher than short-term rates. This is also called an inverted yield curve. Historically, yield curve inversions have been a reliable indicator of recessions, which of course cause all sorts of bad things like falling markets and just general financial hardship for many people. And of course, the yield curve is not perfect. No single indicator is. At the end of the day, we should use the yield curve, just as one input among many others that we can use to make better informed decisions. That's it. Thanks for watching. I hope you enjoyed this video or found it useful. If you did, please like and subscribe. You can also visit our website to learn more about BCM, what we do, how we can help, and for more content. All the links are in the description below. Thanks again, and please stay tuned for some important information about this video.